Hi everyone, welcome to session number one of our series where we'll discuss why personal finance is probably the second most important aspect of our lives after our own health, and also we'll discuss how credit score works. Besides good health, everybody wishes to have a meaningful life with different goals, from raising kids and helping them to be successful, to traveling or leaving some sort of legacy behind us. In order to reach such goals, one of the main ingredients is money. In order to achieve these goals, each person or family must plan carefully to reach them. When it comes to personal finance, each family must make plans for short, medium, and long term goals. For example, short term, weekly food budget. Mid term, in 3 years, I want to buy a car and I need $6,000 for down payment. Long term, I have a 2-year-old kid and I want to send him to college, and I don't want the college tuition to be a burden for him or for us as parents. What do I need to do in order to achieve that peace of mind?
In personal finance, there are 5 steps in order to succeed. Number one, income. This includes your salary, pension, or social security, income from rental properties or investments. Number two, spending. These are expenses like rent, groceries, and your phone bill. Number three, savings, which is equal to your income minus your expenses. A. These savings may be used for expenses, investing, and protection that we will discuss below. B. It is important to set aside for planned or unplanned expenses. A planned expense might be a wedding, birthday, etc. Leaving aside at least 10% of one's income to cover expenses is a good practice, also known as the 10 rule in personal finance. Number 4, investing. Savings allows you to put aside money for expenses. A portion of that can be used for your future wellness, that is, retirement and investments, that will allow you to earn future income or savings. Number 5, protection. By protection, we mean financial products that protect you and your loved ones. Examples of these products include annuities, property and casualty insurance, life insurance, and health insurance. What is the 10 rule in personal finance? The 10% rule is a savings tip that suggests you set aside 10% of your gross monthly income for retirement or emergencies.
Here are the 6 golden rules of personal finance. They are pretty self explanatory. Number 1, spend less than you make. If you make $1,000, make sure your expenses don't exceed this number. Ideally, it should not exceed 800. Number 2, make a plan. What are you aiming to achieve? Set goals. Are you trying to buy a house, buy a boat, pay for your kids' college? All this require disciplined savings for a period of time. Number 3, budget. Using a personal finance spreadsheet works well for this. Forecast expenses and income to determine the amount to save for future goals. The key here is to stick to your budget. We'll discuss this in more detail in the budgeting session. Number 4, emergency fund. One may choose to put aside a certain percentage of their salary for unforeseen expenses like medical expenses and job losses. More to be discussed in a later episode. Number 5, pay off your debt. Debt could be mortgage, credit card, or loans with high interest rate that is going to eat up your income and savings. One should choose to pay this off in a systematic and organized way. Number 6, invest. One may choose to invest in the stock market, fixed income, precious metals, etc. from their savings in order to generate a rate of return. The S&P has returned 9% for the past 100 years, so it's a good place to start. The thing to note, however, is that for high interest credit cards or loans that charge 15% or more in interest, one may choose to pay down the debt instead of investing that portion.
First subject that we will talk about is the credit score. A thing to note is that this is applicable only in the US. You may ask why credit score is important. This is because it affects your day to day life and has a deep impact on your future financial situation. In this session, we will cover why do you need a good score, what is credit score, how it is calculated, what steps do you need to start and or to improve it, how this score influences your financial situation, and how can you access it. First question that many people ask when it comes to credit score is, why do I need it? This score is a prediction of your credit behavior, such as how likely you are to pay a loan back on time based on information from your credit reports. It is represented with a three-digit number that is provided by the credit bureaus, which ranges between 300 to 850. This will help you to do anything ranging from renting an apartment to buying a vehicle or opening a credit card. For example, if you have a good score when you rent an apartment, the landlord may ask for a smaller deposit or even waive the deposit requirement. That translates to having an extra $1,500 in your bank account. Another example is when you buy a car. You probably saw on TV commercials that advertise special loan interest rates only for well qualified customers. What does this mean? It means that the customer must have a high credit score, for example, over 750, in order to qualify for that special rate.
Now that you know how the credit score impacts your daily life, you may ask how the score is calculated. At this point comes into play the credit report. Credit report is a comprehensive report of all your financial dealings from checking accounts all the way to loans, credit cards, etc. A credit bureau is an organization that collects and researches individual credit information and sell it to creditors for a fee so they can make decisions about extending credit or granting loans. Currently, there are three companies that generate your credit score: Experian, Equifax, and TransUnion. Yes, in reality, you have three different credit scores. Here is an example of credit report. It includes your personal information, name, all known addresses, etc. All your loans, student loans, car loans, mortgages, etc.
This is the credit cycle, a process that determines how your payments play a major part in your credit score. There are four steps in this process. Step 1, you pay the lender. Step 2, they update their records. Step 3, your credit history is shared with credit reporting companies. Step 4, credit agencies then shares your information with new lenders. How this cycle can improve or lower your credit score. If you pay the lender on time or pay off your loans, the same information is shared with other lenders who will have confidence in your ability to pay off or pay down your loan. If your interest payment on your loan is $50 per month and you pay that consistently, your credit score will improve. If you do not show consistency in your payments or do not pay your loans or default on them, your credit score will go down, which will affect your ability to get future loans. A tip here is to pay off your loan ahead of time, which will really improve your credit score. Loan companies structure their loans in such a way that payers will pay their interest for an extended period of time before getting to a portion of the principal. The goal should be to pay down bigger amounts than the interest payments and pay off the loans ahead of the payoff date, thus paying off the interest and principal faster. We will go into this further in the loan section of our series.
Next, we will discuss what attributes contribute to your credit score. As you can see, the largest impact is the payment history. If you pay your bills on time, your credit score will not be impacted. But if you start becoming delinquent, your credit score will get a hit immediately. However, there is a major caveat that we must take into consideration. In general, banks will report you to the credit bureau if you are delinquent more than 30 days. If you miss to pay a loan for 5 days, there will be no impact on your credit score. The second largest attribute that impacts your score is the amount owed. More money you owe, higher risk you may fall behind on your payments. There is no general rule about what should be the max amount borrowed, since people with higher salaries may have larger mortgage loans, bills, etc. This is based on the entire amount you owe on your various loans and credit cards, the number and types of accounts you have, and the amount of money owed compared to how much credit you have available. High balances and maxed out credit cards will lower your credit score, but smaller balances may raise it if you pay on time. New loans with little payment history may drop your score temporarily, but loans that are closer to being paid off may increase it because they show a successful payment history.
The third attribute that plays a role in your credit score is the length of the credit. There is a higher chance to have a better score when one's credit is older. This is because if you have had long financial relationships with financial institutions, that means you have been a good customer and you paid your bills. For example, one person has a credit card opened 15 years ago and is in good standing, whereas another person with the same age has the oldest credit card that was opened just 2 years ago. For a financial institution, that may be a red flag. New credit accumulation is the number of credit inquiries and new line opening dates in the last 12 to 18 months. This is where hard and soft credit inquiries are considered. Some other factors to consider when evaluating hard versus soft credit inquiries. Hard inquiries occur when you apply for new credit or services. A soft inquiry is a credit check that does not damage your credit score in any way, since you are not applying for new credit. When you apply for new credit, inquiries remain on your credit report for 2 years. FICO scores only consider inquiries for the last 12 months. For example, a new credit application can be for a Macy's credit card when one already has a Chase or Bank of America card. These applications impact your scores, as hard inquiries are typically made. On approval, these will be additional credit lines to the ones you own already. For example, mortgages, student loans, and other credit cards, etc. The last variable used in building the credit score is the credit inquiries and new loans opened in the last 12 to 18 months. This is important because if you have multiple inquiries, it may signal that you tried to get a loan and for some reason the financial institution denied your loan application. Type of credit or credit mix is 10% of your credit score and is based on the type of credit, showing that you can responsibly handle a mix of credit. What do we mean by that? Credit mix can include revolving and installment loan accounts. To be more specific, revolving accounts are those that provide you with credit that allows more flexibility regarding the amount paid monthly that are subject to any minimum payments required and payment due dates, etc. Some of these include number one, credit cards or retail store cards, number two, gas station cards, and number three, home equity lines of credit or HELOC, installment accounts. These type of accounts usually require a fixed payment each month until the balance is paid down in full. A few examples of these are mortgage, auto loans, and student loans. Please note that installment loans like auto, mortgage, and personal loans raise scores, while revolving loans like credit cards tend to lower scores.
Now, you may ask how long will the personal financial information stay on your credit report? It depends on the charge type as you can see in the table. Open accounts will stay indefinitely, while the actions that negatively impact your credit score will stay for different time frames. Bankruptcies 10 years, credit inquiries 2 years, and so forth. Now that you know how the credit score is generated, you may start asking, what can I do to improve my credit score? There are many ways to improve your credit score, but ultimately it depends how financially responsible you are. Here are two examples. Example number one, a utility account in your name. Most utility bills typically have no impact on your credit score because the information is not generally reported to credit bureaus as they are not credit accounts. However, if you become delinquent in paying your utility bills, the utility companies could report the late payments to the credit bureaus and your credit score could decline. Situation number two, apply for a credit card and use it responsibly. A well managed and long held credit card could help to build your credit score over time. A good credit score could improve your chances of being accepted for credit in the future. When using a credit card, always make payments on time and minimize what you spend. At this point, after talking about how the credit score is created, you can easily deduce what will hurt your credit score: bankruptcies, missing payments, late payments, owing a lot of money, using credit cards in an irresponsible way.
Now that we know what are the components of the credit score and how it is calculated, let's take a look at how financial institutions break down your credit score. 300 to 629 is considered a bad credit score. 630 to 689 is fair, but still you will have to pay high interest rates for loans. 690 to 719 is good. You are close to being a prime customer, but still not up there yet. 720 to 850 is excellent. This is where you qualified for those special interest rates advertised. Also, something that a lot of people ignore. You can request and review your credit report each year from the annualcreditreport.com, where you will get a report from each provider: Equifax, TransUnion, and Experian. The last thing that we would like to touch on in this session, more like a teaser, is to show you how the credit score affects your finances. In our example, let's say you buy a vehicle and you finance $25,000 for 60 months. If you have an excellent score, you will qualify for the best interest rate available on the market, that is 5%. In that case, you will have a monthly payment of just over $400, and during the life of the loan, you will pay almost $4,000 in interest. On the other hand, if your credit score is below 620, then you will get the highest interest rate on the market, that is 20%. In this case, your monthly payment will be $600 per month, and by the end of the loan, you will pay $18,000 in interest. So, as you can see, there's a huge difference between a 750 and 620 credit score. Please join us for the next session, where we will have a detailed discussion about loans, how they work, principal versus interest, loan amortization, etc. Please don't forget to follow us on Facebook, YouTube, X, TikTok, and Instagram.